Here at the center, we are focused on the intersection between policy and markets, and that's what you saw this morning, but we are also the center on global energy policy, and so we're going to close out the day today by taking a global perspective with a really distinguished lineup. Thanks very much, everyone. With a really distinguished lineup of people who are leaders in energy from around the world. So I'd like to ask Mario Beauregard and Sheikh Nawaf Al-Sabah and Sam Muraki and Charif Souki to please join me on stage and take a seat, and I will quickly introduce them. Mario Beauregard is the Chief Financial Officer of Pemex. Prior to his appointment as Pemex's CFO, he served as Financial Director for OHL Mexico. Before that was with Banabras, Mexico's development bank. He worked at the IMF as Mexico's alternate executive director, among many other positions in finance. Sheikh Nawaf Al-Sabah is the Chief Executive Officer of the Kuwait Foreign Petroleum Exploration Company. KUFPEC operates in 15 countries, aims to grow its production to 200,000 barrels a day by 2020. Prior to his appointment at KUFPEC, Sheikh Nawaf spent 14 years at KPC, the Kuwait Petroleum Company, most recently as Deputy Managing Director and General Counsel. Prior to joining KPC, he worked as a corporate transaction attorney at Gibson Dunn. He holds degrees from Princeton and Harvard Law School. Sam Muraki is a member of the board of Tokyo Gas. He served until April 1st as its vice chairman. Previously, he served in numerous other leadership roles, including executive vice president. He joined Tokyo Gas in 1972 after graduating from the University of Tokyo, served as chairman of the Japan Institute of Energy from 2011 to 13, and has been director of Gas Malaysia Berhad since 2014. And then finally, Charif Souki is the chairman and CEO of Cheniere Energy. Cheniere's facility at Sabine Pass, Louisiana, is the first LNG export facility to be built in North America in over 40 years, expected to go into operation, I believe, later this year. Charif was elected chairman of Cheniere's board in 1999, served as CEO since 2002. It would take a whole book to go through Charif's remarkable and colorful career from investment banker to restaurateur to gas importer to gas exporter. Actually, that book was already written by Greg Zuckerman of the Wall Street Journal. For those of you who haven't read it, I would recommend it. And he knows this campus very well, having attended the Columbia Business School. I always learn a tremendous amount from having the chance to spend time with Charif, and I look forward to learning even more with him right now. So please join me in welcoming our panel. Charif, let me start with you. We have a lot of students here, so it's always useful for them to know about useful resources. One is EIA's Today in Energy that you can sign up for, and great little nuggets of energy information emailed to you every morning. This morning's is about U.S. natural gas exports, and that the U.S. is going to be a net exporter of natural gas according to the EIA in 2 years. But they also show how wide the variance is in their projections of how much LNG the U.S. will be exporting based on the oil price. So I was wondering if you could talk a little bit about the impact of the oil price drop, how plans are coming for Sabine Pass and Corpus Christi, but then also how the impact of the oil price drop, in your view, affects the outlook for U.S. LNG exports.
I mean, first, something very paradoxical happened in the last few years. The first one is as the world went away from oil indexation to price natural gas on a global market, the U.S. became highly dependent on oil prices to price or to continue to discover natural gas supplies and to increase production in the U.S. So strangely enough, now in the U.S., we're price sensitive to the price of oil in order to drill for natural gas, because 80% of the wells drilled in America are directed to liquids but find methane as a byproduct. And at the same time, the rest of the world, and for the first time, producers and consumers agree. Indexing natural gas to oil prices is very dangerous, and depending on where you are in the cycle, it may be beneficial to the suppliers or beneficial to the consumers, but never forever. So, and when it hurts a lot. So we're finding now a world that is trying to find a new mechanism in terms of pricing natural gas, and a U.S. market that seems abundantly supplied in natural gas for many years to come, probably decades. That will change the nature of the parameters. We're on the verge of starting natural gas exports in the form of LNG by the end of this year. There's 4 or 5 projects that have now reached final investment decisions or very close to do so. Together, by 2020, they will be able to put roughly 70 million tons on the market, which is a very significant amount.
It's about 10 BCF a day.
That's roughly 10 BCF a day. And I think what people are missing at this stage is that once you've set the first generation, relying on the previous panel to finance you, and strangely enough, I did business with all 3 of them. So they sharpen you because they're so smart, but they also make you very, very careful. When you start dealing with reinvesting your income from the first projects, your cost of building the facilities decreases dramatically. So the next wave will come from the existing projects. The existing projects will have the ability to add LNG production at roughly $600 a ton in cost in the United States, which basically allows natural gas from the United States post-2020 to reach Europe, assuming gas prices stay the same in the US, at right around $6 in MMBTU, allowing a very nice 20% return on your incremental capital. So I think post-2020, the US will continue to be able to grow its LNG export capacity by a factor of 10% per year for a very long period of time.
And the demand for that LNG, you know, for a long time people had said, oh, only Asia with its oil-linked pricing is going to be a market for US gas. It's not going to make economic sense to bring it into Europe. Is that still the case or not?
Well, I do think we're going to have a new set of conditions. If you believe that Henry Hub prices are going to stay around $3, we, for instance, will be able to make a 20% return on our investment, landing gas in Europe at $6. So I think the US will become a very significant factor in European markets, and American gas will determine what Europeans pay for their gas prices, because I don't see Henry Hub really moving much from the $3 benchmark anytime soon.
Muraki-san, how do you see the picture from Japan in terms of the outlook for LNG demand with the oil? But with the drop in the oil prices, are customers losing interest in LNG imports, in LNG from the U.S.? What do you think the pricing formula, the contract structure is going to look like moving forward?
Yeah, the drop in oil prices and also the U.S. export of LNG starting the end of this year, those two phenomena will have a substantial impact on the Asian gas market as well as the pricing mechanism. I think it's good timing, good opportunity to reconsider the pricing mechanism from decoupling from oil price. For instance, in the 90s, when the oil price was low, producers were concerned about the price risk. Then gentle slope, fixed price, S-curve, those type of the mechanisms were implemented. However, from coming into this century, oil price stays high, so they forget about it. But now, producers now reconsidering the prices. And then U.S. natural gas will come into this market. This is a different business model. This is the Henry Hub linked tolling arrangement. And also, as Mr. Souki mentioned, that it's very price competitive. So I think it's the U.S. will bring Henry Hub as well as possibly some project can offer a fixed price to the market. And in the Asian market, the new market will emerge in Southeast Asia. And also, in Japan, liberalization market reform will proceed. So end users will become the buyers of LNG in a few years' time. So different price signals coming out from the market. And so different type of the pricing, different type of the conditions will be coming to the market. So I think it's the U.S. LNG is very important option for the portfolio of the buyers in the Asian market.
And can you just to follow up on that, we've seen this real, significant change in the pricing of natural gas into Europe from very little being hub-based, most of it oil-linked, to 50 or 60% now being sold on the basis of spot prices. What does it take to create sort of an Asian trading hub like that, and to start to see much more of the gas being sold in Asia on those kinds of terms?
Yeah, in addition to the pricing, the advantage of the U.S. LNG is the destination free. As you are aware that the traditional Asian LNG has a destination contract, so it's not flexible for the destination. So this will liquidize the market. And also the spot trading will be expanded. So that creates a possibility of the trading market. However, to create a hub, I think its market side need to be changed. So more liberalized market and different players come into the trading market and activate the trade. Then hub will be created. So I think to form the hubs in Asia, it takes some more time because not only the LNG liquidity of LNG, but the market needs to be changed.
Nawaf or Mario, do either of you want to come in on the question of sort of the changes you see in the global gas market and what impact U.S. Might have on that?
Well, yes, I think that the market is reacting to low prices. But I think that the channels of how this gas is traded around the globe will have an impact on this decoupling of oil prices and gas prices. So far, the U.S. has been a very big producer of gas, and as my colleague also said, in Asia there is plenty of demand for this kind of products.
I'll add a little bit of perspective. As COFPEC, we are an investor in the Wheatstone LNG project in Australia. So we do have gas to sell. Most of it is going to Japan, customers in Japan. When you think about new LNG, when you think about new projects coming on stream, it makes sense for companies like Mr. Souki's to price at their local price, whether it's Henry Hub or what have you. But when you look internationally around and you look at new projects coming along, yes, of course, buyers are pushing towards Henry Hub prices, but I'm not so sure that sellers are accepting that as much because in the end, these are projects that need offtake agreements, firm offtake agreements before you get to FID. And if there's that disconnect still, then it's not really, I think, a done deal right now that you're definitely going to move towards Henry Hub pricing or a firm decoupling. I think so long as investors, sellers in this market still cling to oil prices, and certainly a company like ours, which is heavily oil-based, would prefer to have the exposure to the oil price than to a Henry Hub gas price, we wouldn't make those types of investments.
Right. There are several questions we've gotten about LNG exports, but let me come back to that because I want to make sure we cover a couple of topics and then we'll circle back. So Nawaf, let me stay with you on the oil market. First, there's been much speculation about what's driving the Saudi oil policy. So I want to ask you from your seat in Kuwait, how, first of all, is OPEC still relevant? Should we think about OPEC as a functioning entity? And what do you think is motivating what the Saudis are doing now?
Sure. Just because I come from Kuwait doesn't mean I have any better insights than anybody else. But I'll give you what I see. I had been going to OPEC meetings for about 15 years until a couple of years ago. Thank God I don't go to those anymore. But what I had seen in those in the past, and I see still, is that this is an organization that is not politically driven anymore. It is economically driven. These are people trying to make the best decisions for their countries, for their home budgets. What's driving OPEC right now is, I think, a realization that to remove the lowest cost barrels to act as a swing, to create an artificial floor for the highest cost barrel just doesn't make any economic sense anymore. Now, a lot of people have been saying the general consensus is that this is an economic war, if you will, against shale oil in the United States. I'm not so sure that it is, because you see a race to the bottom between prices and oil prices and costs in the United States. Whoever gets to the bottom first will be the winner, whether it's prices driving out production or costs going down faster than prices have gone down and therefore maintaining the production. But what happens is other projects around the world get impacted. So it's not really, it's not designed, I don't see it designed as something that has a target of US shale. I think it has a target of high cost barrels, whether they are shale, which no longer is the case as prices and costs go down. It may be other projects around the world that rely on $100 oil to be cost efficient, and that no longer is the case.
Yeah, there was Ed Crooks, and one of his colleagues had a good piece in the FT today about how, paradoxically, one of the best things to happen to the U.S. oil industry might be the oil price drop and the reduction in costs. I don't know if they would agree, but that was the point of the piece. So just to make sure I understood what you said, though, you know, it's not politically motivated, it's economically motivated. We're going to let the price fall and let the higher cost producers balance the market. People in North America and elsewhere have complained for 40 years about the existence of a cartel in the oil market. It doesn't exist.
And now you're in a position where you don't have a functioning cartel. So you are in an open free fall and letting market forces work as poorly or inefficiently or as efficiently as possible. But what we see going forward is, what I'm most concerned about, honestly, is potential underinvestment in the industry going forward. OPEC spare production capacity is about just over 2 million barrels a day right now. Demand increasing about 1.2 million barrels a day, more or less year on year for the next 5 or 6 years. Non-OPEC supply will increase, will account for that. I think demand is increasing basically as much as supply will be increasing over the next few years. And then you're going to start seeing a constriction of OPEC spare capacity. In the next 5 years, you'll see it drop from 2.5 or so million barrels a day right now, potentially to just over 1 million and perhaps even less, and that becomes dangerous. That puts you into a world where you enter into, for lack of a better term, a super spike period where you have increased volatility, and because of underinvestment, perhaps in the next few years.
I want to turn to ask Mario about what's happening in Mexico, but just anyone else first on kind of OPEC and the Saudi oil policy. If anyone else has comments, do you all agree that we now have the free oil market that people have said for many years they supposedly want? Supply and demand will determine the price. Charif?
Jason, beware your wishes, they might come true. I think Nawaf is absolutely right. There is a realization now that there is a market. You can't fight it, so why try? And at the end of the day, everybody has the same equation. If I think oil prices with a lot of volatility are going to be at a new medium, or no new median, then the equation is very simple. How many barrels do I need to sell to balance my budget on a long-term basis? You can spend a year or 2 or 3 working at a deficit, but ultimately you need to get at that price level that allows you to have a balanced budget. And it makes sense for everybody, and that's the new world we're living in. So there are countries that are low-cost producers, like Saudi Arabia, Kuwait, and the Emirates, which have the privilege of saying we can choose at what level we want to stop. And that has to be with our internal requirements on a long-term basis. Then you have other countries that are high-cost producers. They don't have that luxury. And you have in the middle somewhere the United States with this incredible phenomena that Zach was describing, where in less than 12 months, the swing between exit rate and exit rate can be 2 million barrels a day. So that's as much as the entire spare capacity of OPEC. And it changes in 1 year. So you've got this incredible new phenomenon that is very, very short term, where in 1 year you can have very significant adjustments on both sides. And in this world, you have to make long-term investments. And people who used to say, okay, here's my price revision for the next 40 years, and this is what I'm going to base my investment on, have to look at a picture now where every 3 years, you're going to go from one cycle to the other with very, very different pricing mechanism, and you need to live with this new environment. The good news on the other side is because America lives with a very short-term cycle and very micro decisions, you don't have to have 20 years worth of offtake agreements anymore. You can make decisions. We make decisions to drill wells with $5 to $10 million. We make 40,000 of those every year. But it's a micro decision. There's nobody who needs to plan what is going to happen for 25 years. We can build spare capacity for LNG exports with maybe $1 billion investment, and that's not a very significant market. You can do it with a 3 to 5 year offtake agreement as opposed to a 20-year offtake agreement. So the world is changing where the investment mechanisms are completely different. You need to look at parameters that are completely different, and you have to be making allowances for very high volatility that is going to go in cycles very, very quickly. And it's a new world, and that's what we now need to adjust to.
So the U.S. is the world's new swing supplier, or am I putting words in your mouth?
I think by the function of being a free market and completely free market, the U.S. is now the swing supplier.
Any other comments on that?
Yeah, I tend to agree that this is more like a free market condition. I think the important thing is to realize that the OPEC countries have the ability to produce more or to reduce production very quickly. So this condition of being the United States, the more powerful right now in terms of production, that can change very quickly.
Great. Let me stay with you, Mario, to kind of ask you what's happening in Mexico. How are Mexico's constitutional reforms going in your view? What's the outlook for attracting foreign investment and for production? And how is that being affected by the low oil price?
Sure. Well, as everybody knows, I mean, the Constitution was modified in December of 2013. For me and for all Mexicans, I think this is the most important reform that have ever placed after the NAFTA agreement was signed 20 years ago. The implementation of the reform, I think, is going very well. All the secondary legislation was approved by the Mexican Congress in August of last year. And right now we are in the process of implementing the full reform. This means a lot of changes, as you said. The most important one is that the private sector can now invest in the sector along all the value chain. For Pemex, which has been the monopoly for the last 77 years, or used to be the monopoly for the last 77 years, I think it's a very good news in the sense that now we can associate with other companies in order to do all our activities along the sector. Pemex has been a monopoly in that sense. We have embarked in a very aggressive cultural change also inside the company. We need to work a lot with the people to modify the way we work in Pemex, the way we think in Pemex. Now we are going to face also competition. We are going to have the possibility to associate, but we are also going to face competition from other companies. And I think that is going to put the right incentives for the company to be more efficient in the future.
And just the impact of the oil price drop on the market for investment?
Well, there is, of course, an impact. Fortunately, in Mexico, we have a low production cost areas. On average, the all-in cost in Mexico and of all the areas that we got in round zero in Pemex is approximately $23 per barrel. So there is still an interesting margin. We would have preferred, of course, a higher price, no? But still at these prices, there is interesting business to do in Mexico. And that is why in the round one that was announced by the Mexican authorities last year, there is plenty of interest. We have seen approximately around 30 to 40 international companies that have signed for all the data room information. So the first results will be announced in July and the second in September. And I think the results are going to be good news.
And just one last question on that. Mexico is currently in the bid process for shallow water exploration and production. Could you explain what resources will be up for tender, where you expect to see the greatest interest?
Well, I think in shallow waters is the most productive and the most lower cost areas in the country. So I think that in that sense, we will see a lot of interest in that kind of areas, which are the first one to be auctioned.
Anyone else on, I mean, you're looking all around the world for investment opportunities. How do you see Mexico?
Absolutely. We've signed an MOU with Pemex to work together in Mexico. It's one of the regions where we have an active focus on, and we really would like to be one of the companies partnering, especially with Pemex and with other companies, international oil companies working in Mexico. I can't say enough about the breadth, depth, scope, and seriousness of our brothers in Mexico about their constitutional reforms and how seriously they take all of this. So I think I applaud you for that, and it's something that we would all like to be involved in. COFPEC is also looking very seriously at the United States and the opportunities that we see here. We see a disconnect still between sellers and buyers like us. I think people still don't have a common understanding on what an oil price deck looks like. Shell, in their acquisition of BG, albeit that is a strategic acquisition, there are other drivers going, but Shell put out their price deck. It's very interesting. They put out the numbers exactly where they thought prices were going. I think they might be a little bit optimistic, but they're not completely far off, I think. I think sellers still, to use another phrase, you know, from a different political environment, they're not going to snap back these oil prices. They're not going to snap back to $100 a barrel. We are in a new normal. We're going to be in this for the next few budget cycles. So I think as sellers come to that realization, buyers will be able to transact. I think it's consistent with the previous panel's discussion. But you just need that understanding on prices.
And there was also a story in the FT today about Shell and Total holding off on offshore Africa projects as you're looking around the world also at making investments. We talk a lot about the impact of the oil price on U.S. shale, but how do you see it on offshore, deep water, Arctic?
I think Arctic is extremely challenged at this point. I think when you look at deep water, you're talking about multi-billion-dollar investments that will be challenged, I think, at this point. But you also see the cost curve coming down as well, and that's more interesting. That contractors now are more available, rigs are more available. The service companies now have a lot of people who aren't doing much, so either they're laying them off or you can get them for a lot cheaper than you could. Mm-hmm. We haven't yet settled at our new level yet. I think the prices still are in flux. You may have seen, you know, we've seen a little bit of a jump up over the past few weeks. And it's a question as to whether that's a dead cat bounce or that's something that's going to last, because typically in the second quarter you expect to see prices go down a little bit with refinery runs dropping. But we'll see, you know, what happens with these investments. A lot of the high cost barrels will probably not get invested.
Let's talk about some other types of energy. Muraki-san, can you talk a little bit about the latest on the nuclear in Japan and when, with the pace at which the nuclear power will be brought back online and how low oil prices affect Japan's ability to diversify its energy sources?
First, on the low oil price, of course, is a positive for the trade balance and the economy. And in terms of nuclear, the restart of the existing nuclears, now 24 units have applied restart, and 4 units are judged to meet the new safety standard by the nuclear regulatory authority. And the first unit we expect to restart sometime in July this year. There are 2 steps. One is the permission from the authority, and then permission from the agreement from the local community. Those are 2 issues. However, now every single unit is facing the lawsuits. There were 2 judgments. One local court, the judgment was in favor of the restart. So they rejected the court case. However, another one, the judgment is stop the restart. So the different judgment came out. So it is another uncertainties and the time-consuming process. But once the restart happens, the capacity of the Nuclear Regulatory Authority probably around 4 to 6 units can be the maximum to be approved every year. So to restart the 24 units takes 4 to 6 years if the process moves smoothly. And then now, government just started the discussions on the long-term energy mix through 2030. Of course, it needs to address the climate issue. And 2 issues. One is what is the share of the nuclear in the power supply in 2030, and another one is the share of the renewables in 2030. And recently, government mentioned about their plan, the nuclear 20 to 23%, and the same like renewables 20 to 23% in energy electricity supply. However, to increase the share of nuclear to 23% by 2030, they have to extend the lifetime from 40 years now to 60 years. It can be a difficult target to change. If the lifetime is limited to 40 years, probably the possibility is that the share of nuclear in 2030 will be less than 15%. And renewables to increase more than 20% is also the very tough target. So if the nuclear limit less than 15% and the renewables around 20%, the remaining 65% need to be supplied by the fossil fuels. So natural gas will be the primary energy to fill this 65% remaining portion.
And just a reminder for those who are listening online, my name is Jason Bordoff, the director of the Center on Global Energy Policy. We're here with Charif Souki from Cheniere Energy, Sam Muraki from Tokyo Gas, Mario Beauregard from Pemex, and Shaikh Nawaf Al-Sabah from the Kuwait Foreign Petroleum Exploration Company. Let me stay with you, Muraki-san, just how you see renewables in Japan's electricity mix. We've seen tremendously exciting reductions in the cost of solar in particular. What do you think the outlook is for meeting electricity demand there?
The cost of the solar will decline, and however, we have a siting problem and also the grid connections. Particularly the wind farms, the appropriate siting is the northern part of Japan. It's not well developed, the power network is not well developed. So I think this access of the renewables to the grid becomes an issue in Japan now. So how to cope with this kind of issue is has a big impact on the future share of the renewables. And we introduced a feed-in tariff system 2 years ago, and the increase of the solar is making the electricity price for the customers to be higher, not as much as the Germany. However, that is another concern from the market. So it is, again, and I would say it is very difficult to increase the share of renewables more than 20% in 2030. It's very, very tough target.
So I want to, we have a sort of shift to some questions we've gotten, and several bring up the topic of looking at the demand side and also the sort of stranded assets question and how you think about climate risk. So, you know, one question in particular is about when we think about meeting climate goals and the idea that we might not need to consume all the oil and gas reserves that we have, how does that affect the hydrocarbon market and investment? But when you look at vehicle efficiency improvements, at the Paris climate negotiations, at what's happening around the world, how do you, in your own investments, think about different scenarios for hydrocarbon demand? Charif, how do you think about it?
From our standpoint, it's hard to visualize non-hydrocarbon demands growing fast enough to offset the natural growth of energy needs on a global basis. So whatever you do, if you want to bring the developing world to standards that are comparable to the Western world, the demand for energy is going to increase very, very dramatically. The reliance on coal might diminish, but the reliance on other fossil fuels is going to increase. As Mr. Muraki was saying, relying on nuclear is very difficult in most environments. Maybe in Japan it's an exception, but I don't think in Europe or in the United States you're going to see an increase in nuclear power anytime soon. So you're left with solar and wind, and I don't see the growth sufficient to offset the kind of demand growth you're going to get from developing countries. So I think for a while now we're going to have continued reliance on hydrocarbons unless you want to take the position that the developing world doesn't deserve to catch up, which is a non-starter.
And do you see a scenario where, you know, more aggressive climate policy might change that trajectory, or that seems?
No, I don't think they're mutually exclusive. I think you can very well do this and improve the carbon footprint at the same time. There are certain things that I think are necessary and make sense. But you're dealing with a world now where hydrocarbons are going to be cheaper than what we've experienced for the last 5 years. And we're still in a system that really doesn't impose a cost on carbon emissions, which is a mistake.
A mistake not to impose carbon emissions.
Yes. So I think the notion of a carbon tax is very helpful because it helps the process and it helps make reinvestments in improving the process to make sure that we reduce the carbon footprint. So there's a lot of things that can be done. And if you increase the use of natural gas, it's going to be an improvement. But even with natural gas, there's a cost involved, and you've got to factor it in.
Nawaf, is there a scenario in which, when you look out, you know, into the outlook, not in a couple of years, but further down the road, peak oil demand is possible?
I don't see it yet. We had, you know, the peak theorists have come and gone. Every generation gets them. Every generation has them.
That was on the supply side. But
yes.
Yeah.
But also on the demand side, I think we still see, you know, whether the United States has peaked in demand or not, Europe may have or not. When you look at the developing world, as Charif was saying, there is still plenty of demand to come from there, whether it's China and India or even Africa once the development really gets going there. Right now, we look at hydrocarbons, we look at the mix, the mix of energy. I still see oil is about, what, 32% or so of the overall energy mix today. 5-6 years from now, with a larger pie, oil will still account for about at least 30%. So there's still a lot of growth on that on that side, especially on the oil side as well as everything else. Sure, there's going to be more in renewables. There might be more in probably less in coal, but in gas, LNG, you'll see a lot more there. What are we doing about it in terms of our investment strategies? We're investing as I was saying, we see oil demand increasing to about 100 million barrels in the next 5 or 6 years. That's a lot more barrels, even if you account for another doubling of U.S. shale. You've got to replace, and that's a big if. You've got to replace all the declines around the world. You're still going to rely on OPEC. You're still going to rely on the OPEC core countries, being Saudi Arabia, Kuwait, and the Emirates. We also see what internally in Kuwait, for example, just as one of the producing countries, what are we doing about it? We have a mandate from His Highness the Emir of Kuwait to have 20% of our electricity through solar. We in the oil sector in Kuwait are probably going to be the first people to try to do that, just to follow through on the Emir's challenge. And that's going to be a big challenge. But if we can do that, that'll help replace a lot of energy use carbon footprints as well.
Yeah, and then of course the question that raises, I'm sure people are scribbling on cards now, is sort of, what if that outlook for the role fossil fuels plays just is not consistent with what many people say needs to be done on climate change. I think that's where the question kind of comes from. And whether people can see a big transition happening in the way the transportation sector works and how people move, that really could have, is there some scenario you see that could have some of a tipping point in terms of how we think about oil demand? I don't know, Mario, from your standpoint, how you think about that?
Yeah, I think if we think that in the medium term we are going to have a price range between $40 to $7 per barrel, I think all these new technologies are going to be more difficult to develop. I mean, at these prices, the use of oil and of hydrocarbons is the most cost-effective. All the infrastructure that we have built in the world is prepared to work with hydrocarbons, not to alternative energy sources. So in that regard, a change in the climate rules of the game would be very costly for everybody. So we really don't believe that will be the solution.
I'm going to try to work through a couple of these other questions. One, Charif, is for you. What's your view of LNG as marine fuel? Can it supplant heavy oil? And it says at the PS at the bottom, you're a brilliant entrepreneur. So I'm passing that along.
Yeah, ask the question again. You went too fast. What was that?
Well, the compliment or the question? The compliment is you're a brilliant entrepreneur. And the question is, can LNG supplant heavy oil as a marine fuel?
It's hard to say, because one day it makes sense, one day it doesn't make sense. So you look at it, and when you have $40 or $50 oil prices, the incentive is not there. When you have $100 oil prices, the incentive is there. So natural gas prices in the U.S., I think, are going to stay in the $3 range, maybe a little bit more, maybe a little bit less. So that's pretty much a constant, but oil prices are all over the place. So when you're trying to make investments that are going to last for decades, with an industry that changes every 2 to 3 years, you tend to stay with the immediate investments and not go to the 20-year investment, because nobody wants to get invested in something that turns out to be a white elephant. So I would have said 2 years ago, yes, transportation fuel, there's a switch to natural gas. It's very plausible, especially in the United States, because the incentive was there. Today, the incentive doesn't exist, so I think it's going to slow down pretty dramatically.
There's also a question about the geopolitical implications of the Leviathan Basin. Let me broaden it a little bit, but given what you were saying earlier about the Henry Hub price and the economics of U.S. LNG exports connected with the oil price, should we be pretty pessimistic about Eastern Med gas or East African gas coming into the market in any significant volumes anytime soon?
Well, I mean, let me repeat what my view is. I think by 2020, you're going to have 70 million tons coming from the United States. And then after that, for the foreseeable future, for several years, maybe a decade, that market can grow at 10% per year. That means that you can deliver gas to Europe, and assuming Henry Hub stays around 3, somewhere between $6 and $7 very profitably. And you can do it to Asia somewhere between $8 and $9 very profitably. You don't need long-term contracts, you don't need offtake agreements, and you don't need financing because you're financing in the next generation out of cash flow. So with that set of circumstances, the US takes a very important geopolitical role in terms of being able to affect prices on a global basis and affect security of supply for many countries around the world. And it changes the parameters very dramatically.
Let me ask you and everyone else, just bring up one other topic before, while we have a couple more minutes. At CERAWeek last week in Houston and elsewhere, the topic of crude oil exports is getting a lot of attention these days from the U.S. Charif, you know something about government permitting and the process of approving exports in a different fuel. But how important do you think it is, given the slowdown in production, given that processed condensates are allowed to be exported, how pressing an issue is this, and what do you see as the potential impact on the global market if exports were permitted?
Okay, so in the US, my experience, and especially as an immigrant, is that we end up doing the right thing for the most people. And sometimes it's frustrating and it takes a while to get there, but eventually people work through all the impediments, the pros and the cons, and end up doing what works best for most people. There's no question, Don, that on a domestic basis, the increase in production is very beneficial because it reduces the cost to the American family and therefore contributes a significant amount to growth in GDP domestically. There's also no question that the impact on the rest of the world is magnified. So if you look at the reduction from $110 to $50 or $60, it's probably worth 1 percentage point of growth on a global basis. That's hundreds of billions of dollars a year. So there's no question that all these things enter into the picture. And at the end of the day, if you continue to ban exports from the United States of oil and you create a bifurcated system where global prices are higher than domestic prices by a significant amount, reflected in the spread between Brent and WTI. It is not sustainable. It is not sustainable domestically, and it's not sustainable internationally. So as I was convinced 5 years ago that we would be allowed to export LNG, I am now convinced also that the pressure will be relentless and we will export oil as well.
Other thoughts on, not the likelihood, I don't know who wants to comment on the U.S. government, but what would be the impact? Is this sort of a debate inside the U.S. between, refiners and producers and who captures the rents, or do you think this has the ability to have an impact on the global market if exports were allowed? Mario, do you have thoughts on that?
Well, in our case, we have been making the case to the U.S. authorities that we would like to have a swap between light oil and heavy oil. No? In Mexico, we need light oil, but we produce heavy oil. And in the U.S., in the refinery system that they have here, they use heavy oil. So there is a good case to make, a good business case to have this kind of swap agreement. Now, so far, the authorities have not decided to export light oil to Mexico. But on the other hand, I think that if exports are allowed, that will have a huge impact on prices.
Are you getting any indications or signals about whether and when the swap might be approved?
Not as far as I know. I am not in charge of doing those negotiations, but we have been talking since maybe the last 12 months with the authorities here in the U.S. to have this kind of transaction.
Anyone else? Does it have much?
I won't comment on U.S. government policy, but I'll say from an international perspective, we'd welcome it. We'd welcome the additional crude. It'll balance the spread between WTI and Brent. It would truly create a more open market one that the U.S. obviously always calls on other countries to help implement. So that would be something from our perspective that could actually be quite welcome. In fact, COFPEC, on a pure corporate perspective, COFPEC would also benefit from that because we have investments in Canadian shale that'll produce quite a bit of condensate. If that is able to come through the United States and export, that's a different policy issue. Also, that would create even more benefit to us. So having the open market, I think, makes more sense.
Jason, I have to just point out the irony of OPEC recommending open markets.
I wanted to say that specifically, and I'm going to let you do it.
Being the United States, I don't think it's sustainable.
It doesn't.
Thank you for doing that because I didn't want to say that on my own.
I don't know what OPEC is anymore. After the beginning of the conversation, it evidently doesn't exist. We have a freely functioning oil market. I just wanted to get, if I can, through one, probably just time for one more question that is in the deck here that people asked, and one was about the Russia-China gas deal. Muraki-san, let me ask you from your standpoint in Japan, how do you view that, and what do you think it means for the regional gas markets?
It's a difficult question, but Russia definitely is looking at the Eastern market and the Northeast Asian countries, China, Japan, and Korea. And China is a growing market. I would say Japan is a reliable market for Russia. And however, because of this low oil price, I think my observation is the Russia-China deal is still fragile because this low oil price will give the downward pressure for the price they negotiated, and also the capital expenditure required to build the pipeline and also the upstream. So it will take time, more time than scheduled. And we are now considering the possibility to have the dialogues with Russia in terms of long-term energy cooperation. And I'm proposing 5 issues. One is oil, and 2 on natural gas, 1 is LNG, and another one is pipeline. And grid connection, that is Russia been proposing. And then the hydrogen. Utilizing their hydropower to produce an hydrogen to bring to Japan. So I call it energy bridges to discuss with the Russian party. In terms of the pipeline from Russia, from the Sakhalin Island to Japan in Tokyo area, we studied the cost of the pipeline of the 1,500 kilometers transport 88 BCM of natural gas, which is about 6 million tons LNG equivalent. The cost, estimated cost is $3.7 billion US dollars. It means about $600 per ton of LNG, so which is almost equivalent to the US LNG terminals, but including the transportation, no shipment, no ships. So I think this is very competitive to supply gas to Japanese market. So that kind of discussion will happen. However, we of course concern the position of US against Russia.
Great. Well, this has been, I wish we had much more time. This has been a tremendous panel, a tremendously interesting, informative, and exciting day, a microcosm, I think, of what we're doing here at the Center on Global Energy Policy, from domestic to global, from climate policy to oil and gas geopolitics, from policy to markets and everything in between. It's really, I think, today a reflection of what we're doing here, building a world-leading platform for research, convening, and dialogue about our most pressing energy challenges. And I really appreciate everyone joining us here today and being part of this with us. Please continue to join us. Follow us on Twitter. Look for our research and events online. If you can't attend in person, download them through iTunes, listen to watch our podcasts, or join our events in person. Our next one, which will help us also understand the outlook for the energy markets, is on May 4th at 6 p.m. in the room behind me with the Administrator of the Energy Information Administration, Adam Szyminski, to discuss their new annual energy outlook. And you should all please, after you join me in thanking our panelists, also go to that room behind me, because that's where we'll be having a reception to celebrate 2 years of the Center on Global Energy Policy. Thanks very much.